Welcome everybody to this presentation of our audited results for the full year ending March 2024. If we look at the highlight slide, just moving forward beyond the disclaimer slide, which I'm sure everybody has seen many times, we are we are reporting a very good position here. We beat the market expectations at the revenue and the EBITDA line, and have also reported an improved cash position. That was because of a number of things that we'll get into, but our revenue was driven very, very nicely by North America and Latin America. A strong double-digit performance in North America and good double-digit performance in Latin America. We also reported earlier on in the period that we disposed of equine horse paste. That's the non-core asset that we disposed of. We also sold a couple of unused offices in the period. We removed the equine paste product from our portfolio by sale to an Italian party. That gave us 1.3 million of revenue, income rather, and that was necessary or a worthwhile thing to do because in our hands we are not focusing on equine. That business was non-core, it wasn't doing a great deal, and it was much better to dispose of that to focus on our wheelhouse of poultry and swine. We've continued to invest in our future by making strong investment in R&D, and we've making great progress in both the late stage and the middle stage pipeline of that. And as a result of that, we expect to launch our first vaccine product into the US market in 2025, financial year 2025. So great performance there. Those are the highlights. We'll get into a little bit of the financial highlights and a bit more detail there.
Thank you, David. So moving along to financial highlights, and David has introduced that extremely well. We've got group sales increased by 5% reported to 89.4, just under 90 million. We'll describe how that breaks out between the various segments in a couple of slides' time. Most importantly, and we see this as a highlight, there is a lower reliance on China in particular. The China and Japan segment representing only 28% of group sales. Last year it was 31%, and observers of this business will recall times past when it was approaching 50% of the entire group. So less reliance, lower risk. Outside of China, Japan, we saw a very nice 10% increase in all of the rest of the markets combined. And in fact, what slightly hampered that 5% growth rate overall was currency headwinds. So over 50% of our revenue is derived in US dollars or associated with US dollars. And therefore, in the change year on year, the movement in cable resulted in reduced reduced sterling-based revenue. So if you strip out that effect, on a constant currency basis, our growth rate was 11% and would have been £94.5 million had we not seen those currency effects. Moving on to the second slide of financial highlights. So what else shows up in the numbers? Gross margins are slightly down, 42%, down from 45% in a prior year. Again, the primary impact was from currency. We'll describe that in a little bit more detail and unpick the various components of that in a few slides' time. Notwithstanding all of that, we saw an increase in adjusted EBITDA. EBITDA being our primary profit measure, and you can see a 10% improvement there year on year. That translated into an improvement in margin from 8.5% net margin to 9%. That's a demonstration of the operational gearing within the business. We've got a fairly fixed overhead structure, and again, we'll look at that in a little bit more detail later on. But with a fixed overhead structure, improvements in top line translates into improvements in bottom line. So we see that coming through in earnings per share at 1.55p, up from 1.49p last year. Now that is reported earnings per share on a statutory basis. simply being the profit after tax divided by the average number of shares in issue. In fact, of course, you'll see within the earnings statement that we had an exceptional item of about £650,000. So clearly that was showed up in a depressed earnings figure. Had we adjusted that in our earnings per share figure, and I know a lot of the analysts talk about adjusted earnings per share, that figure would be 2.5p per share. So you can see nice progression from year to year. Turning to the balance sheet, we've got an improving cash position. So we've got £22.5 million of consolidated cash. Remembering that quite a lot of that cash sits in China, where we have a 51% subsidiary. Because it's a subsidiary, we include 100% of the balance sheet and 100% of the P&L for China. But of course, as we extract that cash out of China, that comes out by way of a dividend. And as we do that, we lose 49% to the minority shareholder. And so it's useful to consider how much cash is actually outside of China. And you see good progression there year on year. We're now at 36% of our group cash position being held outside of China, which is nearly double where it was last year. So a very good and useful performance there. Furthermore, since the year end, we have, as we speak today, we've received both dividends from China, which is earlier than we've received in prior years. So that's very useful, shows that the process of dividending cash out of China is now a routine rather than something which has to be tackled for the first time. And then finally, of course, because we've got so much more cash held centrally, that funds our new product development. If you recall, we spend anywhere between 8 and 10% of revenue each year in developing new products. That is quite heavy expenditure. That's pushing along our new products along the development pipeline. We'll speak more about that in a minute, but that's all the policy, the philosophy around new product development is it's all self-funded. So it's funded from the cash flow we generate from the sale of Aivlosin, and we have no need to tap external sources of capital for that new product pipeline. Thank you, Hannah.
So shall I take this one, Chris, just to elaborate on the revenue a little bit. You can see some nice progression on the right-hand side of the rest of the world revenue with what works out to be actually a 6% compound annual growth there for the whole of the business. That's the group revenue CAGR is 6% over the 6-year period that we're reporting here. You see a little bit of a bump of an exceptional year in 2021 in China, but outside of China and the rest of the world, you see a good, consistent growth of revenues. Actually, rest of the world is compounding at around about 10% over the period that we are looking at here. So a nice progression, augmented by progression this year. Next slide, please. So a little bit on China. We don't want to focus too much, but want to give insights here. We were trading well against a difficult economic background in China, both a soft overall economy, softening the demand for pork products in home consumption and restaurant consumption, and particularly at the producer level, the pig price was operating at a level that was below the cost of production for the majority of the year. 10 months out of the 12, producers' margins were being squeezed on that. So it was a tough environment in which, but we progressed very well despite that relatively tough external environment. In order to continue to grow the Chinese market, where we are strong in the swine market, but less penetrated of Aivlosin into poultry, we have some poultry trials underway to help drive that new business and help maintain the business. We also have a fill and finish production plant there that was completed. The new plant was completed around about October, November 2023, and that is now operating at the same or above the efficiency of the old plant. And that was necessary to do for regulatory reasons, but also is now giving us some benefits on efficiency reasons as well. And as Chris mentioned, we have repatriated the dividends from both the joint venture and the wholly owned foreign entity by this time, but in fact by June, and that's earlier than prior. So that is very pleasing to see. Next slide, please, Hannah. I think we've largely covered this already, but I'll just pick out the growth drivers for the two big bubbles. What was helping us grow 22% in North America? That was, in essence, it was excellent execution. Very good go-to-market team there, very good go-to-market strategy. We were able to gain share from our competition due to executing well ourselves and a little bit of weakness in the competition. In Latin America, that 10% growth is driven by Brazil and Mexico. Very strong demand-led growth in Brazil, buoyed by a solid export business in that market. And also subsequent period end, we've gained new customers in Brazil as well. So that's very good. And in Mexico, we have balanced growth between both the swine segment and the poultry segment, and very good sell-out process there. Those are the key highlights on this slide. So next slide, please.
Thank you. And so talking about margins, I mentioned this earlier on that we had the margin reducing from 45% last year to 42% gross this year. So the main impacts or effects which caused that movement, foreign exchange on revenue, that contributed a 3% pull down on that gross margin. The main currencies we're exposed to, mentioned dollars earlier. The RMB, of course, is another one with the China business. Now, on dollars, we also buy our main component of our cost of sales in US dollars. The API, the active pharmaceutical ingredient, which is the main component of the manufacturing of Aivlosin, is a US dollar purchased item, and represents, roughly speaking, 2/3 of our cost of sales, 1/3 of revenue, if you like. You can see how that acts as a very nice natural hedge to the revenue effect. It's not a perfect hedge, but it goes a long way to offsetting the revenue swing. The third item along, 0.3%, a smaller effect, but it's quite an important effect. So this is a net cost of sale decrease, so net reduction in our cost of goods. That comes about because we're able, each year, we have an annual price negotiation on this API that I mentioned earlier. And because of the increase in volumes, we are able to negotiate a reduction in the cost per kilogram active of this API. That offsets very nicely the natural inflationary increases we get elsewhere with our manufacturing costs. The fourth item along is depreciation. This is one-off in nature. You may recall that during 2022 and 2023, we rebuilt the factory in China. In fact, we moved to a new factory next door to the old one. That caused about a 6-month hiatus in production, and during that period, the depreciation on the old factory, because we weren't in production, that ran through overheads. Partway through last year, we started up the new factory. The depreciation naturally associated with the new factory, of course, is a cost of sale. It's a factory overhead. So that then becomes part of cost of sales, therefore is a margin impact. Going forward to next year, clearly that won't repeat because we'll have a full year of depreciation in both years. And the final item is the mix effect you get from different geographies. To give a scale on that, some markets, such as Canada and China, are very high margin. We're getting 60% gross margin in those markets. Compare that with places like Brazil, where the margins are a lot tighter, and we're talking about 25 to 30% there, you can see that the relative mix of revenue in both those markets will and does have an impact upon the overall average gross margin for the group. So moving along to into the kind of overhead section of the P&L. Firstly, R&D expenditure, which is an investment for the future. Here we see the absolute level of expenditure being the total bar, and the two components within that being the amount expensed and the amount capitalized. According to the accounting rules, you can only capitalize when you get to a position of confidence around the ultimate outcome and commercial success of a product. Therefore, by definition, that level of confidence only comes in the later stages of the development cycle. And you can see that that has grown to £4.1 million, pretty much 50% of our total expenditure this year was on those late stage projects. 3 in particular, 2 vaccine projects focused around poultry, and a third which entered capitalization phase this year, being a long-acting injectable treatment for swine disease. So you can see that that is really a demonstration of the maturing of the pipeline of new products. But we're not ignoring the early stage, and half of the expenditure this year was in our early stage and mid-stage projects, and there is considerable excitement in the technologies that are coming through in those phases. So we expect to be promoting some of those mid-stage projects through to final stage in the coming years. Now we talk about overheads, and overheads, important to control these, and very pleased to see that overall cash expenditure or cash-based overheads this year, constant year on year, 25.6 in each period, and only the non-cash charges increased a small amount from 2.8 to 3.2. What do I mean by non-cash? I mean things like depreciation, amortization, charges for share-based payments, and that sort of thing. So not affecting cash, and being really accounting charges rather than real overheads. So very pleased to see that control, and that's very important to achieve that in what has really been an inflationary environment. How have we done it? Well, naturally, we've seen some inflationary pressures in things like personnel costs and marketing, where we are preparing or beginning to prepare for launches in the new products. But we've managed to offset that by reductions in legal audits and professional in particular. That's one of the categories where we've managed to pull down on the costs that we previously incurred. Now, all of that then leads us through to our primary profit measure. So, and on the next slide, we describe the EBITDA bridge. So EBITDA, I mentioned earlier on, is our primary profit performance measure. And I'll just pick up on something that was that we mentioned earlier on. There was a post-balance sheet event described in the release very clearly, and that was around the sale of the horse paste business. So that transaction completed in April, so it was post-balance sheet. So we didn't receive the cash. So the cash that's reported in these numbers does not include that effect, and nor does the earnings stream include that effect. Next year, when we account for that, because it's a transaction, it's structural, we will exclude it from our earnings. It's only fair to show that as a non-routine business item. So how did our EBITDA progress from 7.2 to 8? What were the moving parts? Clearly, we grew in revenue terms, which you can see the contribution there. We had an offset with gross margins, which we described earlier on. Other income was a bit of an odd one in a prior year. In prior year, we had a tax rebate that was accounted for as other income. We didn't have a repeat of it this year, so that's why that's a slight decline. And then R&D expense, whilst we spent exactly the same in cash terms as the prior year, more of it was on late stage with a maturing pipeline, and therefore less of it hit the P&L. So you see the improvements as a result of that. So now turning to the balance sheet, I think observers of this company will previously have noted the fairly heavy amounts of cash tied up in working capital. It's pleasing to see the progress made in that regard. So inventories in particular, down to 17 million at the year end. And what does that mean in the context of trading volumes? Well, you can see the progression from a peak of over 200 days of stock in 2019 and 2022 when we were rebuilding the factory, now down to 120. So that's significant release of cash into cash balances as a result of that. We have just implemented, went live on July the 1st, a new ERP system, which allows us to be much more accurate and precise in our resource planning. And that is the prediction of the amount of inventory we need for each market at particular points in time. That predictability tool will help us as we progress further. I wouldn't want to guide that we can drive too much more cash out of that 17 million, but certainly to stabilize it at that sort of 120 days of trade feels to me to be the right balance of amount of buffer stock to ensure that we can always have stock and we don't have stock out, and protect ourselves against supply chain interruption, which can happen. You recall the ship that got itself sideways in the Suez Canal a year or two ago. We were able to trade through that without interruption, and that's because of those buffer stocks that we carry. The trade receivables, debtor days, did pop up at the year end, so 131 days. We were driving that down nicely, 112, 115, as we were monitoring through the year. We were trading at actually a little below 100 days. The reason why it popped up to 131 at year end was all about phasing of invoicing approaching the year end. So very busy February, very busy March, and that clearly hadn't turned itself into cash by the year end, so that was in receivables. Pleased to say that in looking at the May management accounts, the trade receivables position has come back down to sort of 26 million, hence releasing the 6 million of year-end effect back into cash. So that's a very important measure and control of our receivables position and working capital. Moving to the next slide is the cash flow statement, and that clearly is the other side of exactly what I've been talking about. I highlight there the phasing of sales at year end, which resulted in a change in inventory, so a release of cash into the business of 4.7 million pounds during the year from stock, and an absorption of cash into receivables at the year-end point, 5.3. Said earlier on that has now unwound into cash since the year-end, so very pleasing to see. You'll note that we are quite light in terms of capital intensity. We don't spend very much in capital plant and equipment, and that is associated with our particular business model, which is an outsourced model largely. The only area in capital that we do spend on is, of course, R&D, and that 4.1 was the capitalized R&D that we mentioned earlier on. That obviously shows up as a purchase of intangibles, but basically it's capitalization of the R&D spend. In order to head off the question, I guess people might wonder what the 2.8 million dividends paid is. You might say, hang on a second, Eco is not a dividend stock. Quite right. When we repatriate cash from China, that's repatriated using a dividend mechanism. I mentioned earlier on that we trade in China through a joint venture where we own a small majority, so at 51%. Clearly, when we declare a dividend, we have to pay 49% of that declared dividend to the minority holder, and that is what that is. It's cash leaving the group to the minority shareholder in China. So that's it on cash flow statement, Hannah.
So moving to our ESG posture, we have set out our ambitions around carbon neutrality. We've made some nice progress here this year. We have published our first sustainability report, which is available on our website. We've also made good progress in reducing our energy usage. We've gone completely into emission neutral energy in our main offices. And by reduction of unused office space, elimination by sale, we're able to reduce the energy support there into an empty office by 60%. In addition to that, one of our biggest energy usages is in the pharmaceutical ingredient of Aivlosin in our API, and that is a fairly energy intensive process, but we've been able to reduce that energy consumption via biogas and via additional solar panels at our third-party supplier in China, and that's yielded an over 40% reduction in our energy consumption over the last 3 years. So very nice progress there. And then also we have completed our second engagement survey internally, and this shows very good progress, some fantastic results for internal staff engagement. I point to 93% would recommend Eco Animal Health as a good place to work. 94% showing that they feel that the work that they do has higher value and higher purpose. Some really strong, and that pulls through to us having good retention levels and also being able to recruit into the business, both on the commercial side to support our expansion ambitions and on the scientific and R&D side to support our development program. So very pleasing to see that. Next slide, please, Hannah. Further dive into our R&D program. What have we done and what have we been doing? Well, some good progress here. We have a maturing pipeline, as you've seen in the capitalization percentage that we have, and we have got good progress at our contract manufacturing partner. We have, via that partner, produced the first test batches for our new vaccines. That contract manufacturing partner, we have worked with them to prepare for the US regulatory approval for that site, and that is on track, expected early next year. We've also made good scientific progress. In fact, we have completed some key safety technical sections of our submission to the regulatory authority in the US, the USDA, and we expect our first project to turn into a product, ECOVAXXIN MS. We expect to complete our regulatory submission by 1Q 2025, and after sufficient analysis and look into that submission, we expect product approval by the USDA 2 quarters after that in the 3rd quarter. So that's our first product, and I think that will be an excellent demonstration of our maturing pipeline and a really nice signal to the market that our investment is yielding results. But we don't just have that. We have not only 3 products in the late stage, we have a full pipeline in the medium stage. In fact, in total, we have 9 products that we expect to reach approval in key markets such as the US and the EU over the next 5 or 6 years. We did terminate 1 project in this period, and that is not a negative, that's actually a positive. It shows that our attrition level is low in our pipeline, but we are also diligently managing that R&D portfolio. We terminated 1 product that was actually a duplication. It was an additional shot on goal. It was an additional PRRS program. Our target program there is showing great progress. That is actually our mid-stage PRRS monoclonal antibody that is mentioned on the slides. That is showing good progress, and as that is maturing and showing results, we didn't need our traditional technology additional shot on goal, so that one was terminated. We reported in November at our Capital Markets Day an estimate of all of our portfolio from the mid stage and the final stage particularly, and that Capital Markets Day yielded estimates, probability weighted, that there is substantial value to around about 200 million in revenue and about 90 million in EBITDA held within our R&D pipeline. And that is progressing well. In addition, other markers of progression is that it's not only established our laboratory in the US, which is helping us with the development piece, but we've also established a quality assurance release function in the US in preparation for the launch of our forthcoming vaccines. That has benefits. Why? That's a benefit because it gives us control over our own quality release. Originally, 2 years ago, we were planning to do this with a US partner. Now we're doing it on our own, and that has benefits of not only autonomy, but it also means that we can own our own marketing authorization in the US, therefore giving us greater control and greater autonomy. So nice progress of a maturing pipeline with some definable timelines there and some progress in specific in the US. Next slide, please, Hannah. So that takes us to the summary. What we've tried to show here, and we will now be open for questions, but we've tried to show that we have delivered on revenue, EBITDA according to expectations and actually slightly ahead. We've got particular focuses of growth and tremendous execution in North America and Latin America and growth overall. We've been able to demonstrate that we've got a maturing and valuable pipeline that is hitting its timelines for development, and that we have a product in Aivlosin that is continue to be in great demand despite some headwinds of both currency and difficult trading positions, and yet we're still able to make progress. So very happy to report these results, and I will pass back to Hannah for any questions. Please, Hannah.
What is the effective underlying tax rate likely to be in the medium to long term?
That's a good, interesting question, that one. This year, the effective tax rate, 31%. Slightly higher than prior period. The contributing factors to that is clearly 25% is where you would expect it to be. Clearly, we've got an offset between amortization, which is non-deductible, versus the allowance you get for R&D. R&D tax credits this year. Like most R&D intensive businesses in the UK, there's less of a benefit as HMRC and the government tightened the rules around R&D tax credits. So that has had an impact. And probably I would guide that is where we expect to see the effective tax rate, in those early 30%, late 20%. As an overall group.
Okay, thank you. Let's focus for a little moment on the R&D pipeline. Few questions here on sort of rollout and build up, but let's start with, has there been any material change to the revenue projections of the R&D pipeline shown at the Capital Markets Day back in November of last year?
No material changes. What I would point to is there's a small decrease or a small extension of the timeline of MG. That was necessary as we moved from production site in the US to another partner that was more willing to deal with us, and also improvements in the products that we needed to get a better yield. So that pushed the timeline out by 2 or 3 quarters for MG. But no change in the valuation. So the Capital Markets Day is very, very much still current. There's still potential for that to change in the upward direction, I would say. And the one product that we took out of our pipeline was not material to the overall total value.
Okay. Leading on from that, those that are nearing launch, will you need to build up inventory ahead of this for your new products?
We will build inventory, of course, for our launch. One of the things that we have to do for the regulatory process is build test batches. so that you can demonstrate, and we can demonstrate that we're making, in essence, the vaccines to recipe. And that those regulatory batches that we need to make, we can also convert those into commercial sales. So we'll build inventory for, first of all, regulatory submission, and then we'll use that regulatory submission inventory for commercial sales.
Okay, in what other ways are you having to get the business launch ready for these vaccines in terms of building out a marketing or distribution function?
So we have to prepare the market with pre-launch activities. Things that we can do there is scientific disclosure of our products, gain credibility in the market as a vaccine producer and supplier, gain scientific credibility with the veterinarian community, gain technical credibility with the producer community. So all of these are sort of pre-launch, warming up the market activities, some technical, some scientific, some PR. In terms of staff and distribution, we will need to increase, put on a small amount of staff in the US. I'm thinking, small amount means a handful, 2 to 4 of technical specialists, so that we can give our customers the correct advice on how to use our products. Distribution network, we have that in hand. We have a distributor in the US already, and we have a distributor that will be able to manage the logistics of the vaccine and the cold chain that is required to go around our vaccine. So we have that's part of the pre-launch activities that we've undertaken.
Okay, moving on to Aivlosin. Has the sow claim on Aivlosin helped to drive sales quicker than you were expecting?
I think it's certainly helped to give us momentum in the US, and you saw the very strong growth in North America, and certainly the sow claim there has given us access to a market that we had difficulties tapping into before. So it's definitely given us benefits, and we will get those benefits in other markets where we get the sow claim as well. Has it been more than we expected? I think that growth in North America is more than initially we had expected this year. Not all of that, however, is down to the sow claim. So has it been useful? Absolutely. Has it been beneficial? Yes. Is it more than we expected? I think it's about on par with what we expected.
Okay, well, you've nicely led into another question we have here on the growth in North America. And do you expect it to continue at the same rate going forward, following new client wins that you've seen to date?
I still expect growth in North America. I do not expect 22% to be what we would expect every single year. I think that was a very strong year. It was augmented, as I mentioned, by excellent execution that I think we can continue. We've mentioned the sow claim as well. There was some weakness in the competition, and I wouldn't expect that to be replicated. I think that weakness in the competition, we're able to gain from that. I think it's dangerous to expect your competition to always be weak. So I don't think that bit is repeatable.
No complacency, absolutely. Have you had any success in putting prices up? And if so, has this varied across geographies?
Yes and yes. Yes, we've been able to put up price. For example, in North America, headline price increasing about 5%, and most of that stuck. Other parts of the world, we haven't been able to execute price, so it's been flat on price. So it's been a little bit of a, exactly as the question indicates, a little bit of a mix. So some places, yes. And of course, where we've been trading against historically challenging producer prices, it's kind of difficult to put up prices where when the commodity price of pork is low and producers are not making substantial margins, and that's been the background for much of the year. So being able to increase price in some places has been a good result.
Fantastic. Well, that's it for the questions today. So that just leaves me to thank everyone for joining us and to you gentlemen for coming and presenting to us. And we look forward to an update in 6 months' time.
Thank you very much.
Perfect. Thank you, Hannah.
Thank you.